I think we're all finding that as more and more people get crowded in the space, I put up capital that I
Mhm.
could live with losing completely. Industry changes at a much slower pace than the stock market does. My best cash flowing investment so far, even more
And
than the private debt.
welcome back, investor. We got another episode of Passive Income Adventures. Today, I have a guest who we're going to talk a lot about diversification. If you've been listening to the show for a while, you know that I harp hard on diversification, even though we manage a fund and we take in accredited investors who want to make an income off of what we do. We also really, we can't counsel because we're not financial advisors, but we really do counsel our investors to have a wide variety of things that they're investing in. We just want to be one of them. We understand that we're diversified both in paper and real assets across the stock market, private equity, private debt. We also diversify across risk management, like high and low risk, like high yield, maybe higher risk versus lower yield, super safe and predictable. We also diversify across how much time it takes us to run an investment. Is it completely passive, like in my Robinhood account? Or is it a little bit more involved with, say, vetting out a private equity deal, or all the way up to running my own business, like when we are managing our own properties or running a fund to help other families do the same thing that we have done, where we have enough passive income to fund our lifestyle so we can travel full time and do what we want to do. And we don't have to worry about how to pay for everything. The only thing that we have to think about is like, how do we grow and how do we do more of what we want from a financial standpoint? So today's guest, we've got Keshav Kaur calling in from New York City. Hello, Keshav.
Hey, Emma. Good to
And
be here. I
Keshav,
appreciate you having me on.
yeah, you're another fund manager with Investor. We interviewed Sanjay in our previous episode and talked a lot about the things that Investor can do. And how about we start with telling me a little bit about your fund, what you're doing now, and then we'll dive more into your background, how you got to that point. Just give us a brief overview of what you do, like your mission driven projects that you're working on inside of your own fund.
Yeah, I would say we help tech professionals from some of these big tech companies like Amazon, Meta, Google, etc. build generational wealth, passive income, a lot of the things that you like to educate people on this podcast, help them achieve those goals through passive private equity investments across various industries, primarily right now, private lending, debt, which you're very familiar with, real estate as well. And we're getting into oil and gas primarily for the tax benefits. The fund of funds model is just streamlines all of that, one easy portal for our accredited investors to go into and to see all of their investment opportunities at a glance, pick and choose which ones they want to invest in. Just keeps things really simple. Shout out investor.
Yeah, I agree. It's really nice for an investor to come in there and see what deals we have going and be able to opt in or not opt in to deals that don't fit their profile. It allows us to be a little bit more broad in what we're offering. Like you just mentioned a couple of different things like oil and gas. You've got some real estate in there, some private debt, both with real estate and you do private businesses in addition to real estate that don't have a real estate asset. And just being able to have your a broader base of what your investors can choose from so they can get in there and say, I like this, I don't like that, rather than being in a blind fund where they just have to go with everything we say. And then we have to have a much narrower investment thesis because people don't know exactly what they're investing in a blind fund. And so it needs to be very narrowly defined. So have you seen your ability to broaden that a little bit be increased with something like Investor where it's more customizable? Or is this something that you were doing before in your own portfolio as well?
Was doing it before my own portfolio too, but to a much limited extent. It's just a lot more streamlined now. I don't have to go have my investors sign up on 10 different portals and have them invest. And I think
Mhm.
that was a big hurdle. Getting 10 different K1s from different operators is a hurdle, whereas you get a single K1 for when you invest through our investor funds. And it's just much more scalable, right? I don't have to drum up a new legal document every time. It's a pretty simple deal disclosure where I just outline my fees and fill in some information
Okay.
about the investment. It just makes things easier for us as the fund managers, you and me, and also for our investors investing.
Yeah, way easier. I think we have a template that our lawyer gave us because we do hard money loans, just rinse and repeat, like over and over, very similar. So we just templatize it. Our lawyer just takes a quick look at it, charges for that 15-minute minimum time.
Yeah.
Yes, it looks good. Go ahead. Because it's the same thing over and over again. I wouldn't call us a highly diversified fund. We have mostly hard money in the Mountain West. So fix and flippers in Utah, Idaho. Sometimes we'll do Texas or Hawaii, something like that. But only occasionally, maybe once or twice a year, we'll do a fund of funds for a private equity deal, real estate related. The way that we've structured our fund legally, we have to be in real estate and we have very little options to do anything outside of real estate. So for the listener who knows what that is, it's a 3C5 where 80% of the investments have to be in some sort of real estate backed thing, and then 20% can be in whatever else we want, oil and gas or I don't know, other kinds of businesses. But we don't find ourselves really drawn towards offering much more diversification outside of real estate because we passively invest in that stuff because we don't know what we're doing. And we only want to offer the things to our investors where we really know what we're doing. We know what we're talking about. We know how to vet great operators. So my partner Chris does the hard money side. He's president of Utah REIT, and so he's been doing that for a while. And then I do the multifamily side. And other than that, like we don't do a ton of other stuff because we really want to be experts at it. So walk us through your process of how you're able to offer a little bit more diversification inside your fund. Like I said, I want people to be with multiple fund managers when they're doing truly passive investments. And tell us like what that looks like from your fund to fund side, underwriting something that it might be something that's new for you.
Yeah, definitely. I think for me, obviously I started out in my first LP investment was about 3.5 years ago, also into multifamily. And that beats the stock market, in my opinion. And some of the private debt opportunities that we're in right now also beat the stock market. So those are great. I think over time, I think we're all finding that as more and more people get crowded in the space, that the returns are decreasing over time. I haven't been in this industry long enough to make this statement from experience, but I've at least heard from other folks that back in the day, you could hit 20% IRRs at very high teens in multifamily. Now, because there are a lot more
Mhm.
syndicators, a lot more investors getting in, everything is getting bid up, those returns are being driven down. But you let me know if you've heard differently or seen differently, Emma.
I don't know if it's just because of the increased competition, because certainly there is increased competition when syndication became more mainstream with the Jobs Act and as it was put into practice. First of all,
Yeah.
as more people heard about it, people are coming into the space. So, yeah, increased competition is a big one. Higher interest rates definitely have eroded returns big time. The debt is one of the biggest drivers of returns. And so that's been another factor, several factors. But yeah, I've noticed that the industry standard and what you can make on these big equity deals used to be 17, 20, below 20% IRR per year. And now I'm regularly seeing things in the 14% range just because of it's definitely multi factors, but I have seen the industry standard go down. I don't know if that's because we were in a bubble before or we're in a downturn now. Are those kind of returns going to come back during the next bull market? I don't know because those kinds of returns, we regularly saw those when they were just joint ventures. It just depends on there are just so many things it depends on. So yes, I have seen that. I don't know if it's going to come back. So we have just taken a much more conservative approach with our equity.
Yeah. So that's what I've heard and been seeing. And also, I think as we introduce more people through to these investments, that's a great thing. Obviously, we want people diversified outside the volatility of the stock market. But at the same time, that just means our various investor groups are going to start clashing and outbidding each other over
Mhm.
these. So I will have always known that day would be coming, I think, as we all did. So I want to stay one step ahead and find other opportunities where we could be the early bird. And not only that, but when we look at investments, we evaluate six things, I want to say: appreciation,
Mhm.
cash flow, tax benefits, like charitable investments,
Yes,
liquidity,
impact.
and then impact investments. Liquidity,
um,
do you have a deal that has a 90-day lockup on capital or one that has a 10-year lockup on capital?
Yep.
And then
Bingo.
risk. Like you said, you have high risk, high yield investments, low risk, low yield investments. So for oil and gas specifically, because that's one of the start of our very alt investments, there myself, I'm not a real estate professional yet, so I can't take a lot of the great depreciation benefits that real estate gives you.
Mm,
And a lot of my passive investors, also being in tech and high earning, run into the same problem. And so oil and gas solves that because the depreciation benefits you get from oil and gas can be used to reduce your W-2 income, even if you're not in the
mm,
industry. It can also be used to reduce an unlimited amount of capital gains too. We've
mm.
seen the stock market go bonkers. There's the big tax bill coming for us one day. Oil and gas and other energy investments help offset the large tax bill. And then we haven't gotten
That
into small businesses yet, but that's something we're very interested in, as well as we
okay.
just see this silver tsunami, I think they call it, of baby boomers
Yeah.
retiring, no one available to buy their businesses. So
Yeah, definitely buying their businesses, but also buying the assisted living that they're living in is huge to
yeah,
me because it's like owning the real estate that they're living in, but you're also able to buy their businesses. That's an interesting such an interesting model. Before I definitely want to dive into the tax part of what you just said there because it's unique to what we can do in real estate, pros and cons to everything. And I really want to dive into that. But before we do that, walk me up to your own background. You mentioned that you do some of the underwriting for some of the deals that you invest in. So you obviously have some sort of an analytical and financial background. Walk me through, like you said, the first time you were an LP, what were you investing in before that? And how did you evolve through that period of time to become a fund manager?
Yeah, real estate had always interested me, and I read the classic Rich Dad Poor Dad when I graduated college 6 years ago now. And that did get me started thinking about real estate in general. So I thought, hey, I want to at least start out buying and renting single family homes. So I became a realtor originally in Detroit
Mhm.
right out of college. This was March of 2020. I actually got licensed
Mhm.
on
Oh,
Leap Day of 2020.
yeah.
And then 2 weeks later, we all remember COVID hit, the markets shut down.
Yep.
But later that summer, sold a few homes, started looking at rentals. But luckily, before I dived too deep into that rabbit hole, one of my good friends from college, his dad had just started investing in syndications. My friend came across a Reddit thread where someone was talking about syndications. And he said, hey, my
Mhm.
dad started doing this. You should check out this post, maybe reach out to the guy. Might be interesting. So I reached out to the guy
Okay.
in September of 2020. And all of this was new to me, obviously. None of my family or friends, besides my friend's dad, but he was still new to it too, relatively, had been doing this. So to me, the returns, the tax benefits, the fact that you'd be passive, all this stuff sounded too good to be true. So I actually took a year from September
Mhm.
of 2020 to August of 2020 to do my due diligence, network in the
Yep.
industry, analyze deals, things like that, and made my first LP investment in September of 2021 into an apartment building in San Antonio. And I started seeing the cash flow coming from that. And that was a proof of concept to me that, hey, this works. And then I got the K1 too. So I
Mhm.
started my company in January of 2022 with the idea that, hey, if I'm going to do this for myself, I might as well do it for my friends and family and anyone else who's
Mhm.
interested. And so, as I mentioned, our goal is to help tech professionals build generational wealth, passive income through these passive private equity investments across all these different industries. And I was in college, I was an engineer, trained as an engineer. So I always loved math and
Mhm.
finance, like finance modeling, things like that. On our build to rent developments that we do there, I'm usually handling the underwriting. Other asset
Mhm.
classes, I make sure that I understand the underwriting, but I always trust but verify. But I think I know the way I'm able to diversify across these different asset classes is by finding the expert in it, right? If I wanted to find
Yes.
someone in hard money lending in the Mountain West, then I'd come to you.
Of
And
course.
once I'm done my due diligence, then that's a process too. I'm not just going to say, hey, I've seen this person on social media. They look trustworthy. Let's do some business together. We do our due diligence with the operators that we raise capital for. And during that process, obviously, a part of that is depending on how out of our realm of expertise the asset class is. Part of that process is also, hey, I want to raise capital for you. Bring us like, up to speed on how oil and gas works, for example. So there, I've been able to help put together underwriting models, figure out what our assumptions are, what typical expense ratios look like there, what typical returns look like there, and build up expertise over time. But again, primarily rely on experts, subject matter experts in those asset classes as I ramp up myself and in turn help my investors ramp up on whatever the new asset class is.
Mhm. So, finding the expert. We've all been in situations where there was a charismatic expert who's maybe really good at marketing and they're really doing deals. We're not saying they're not doing deals, but a lot of people just want to invest with this person because they sound like they know what they're talking about. They've been doing it a really long time and they might get into a situation where that person may have grown too big, maybe get a little over their skis, and they have to keep the machine running. And I that makes me very leery of investing with somebody when they are really big, huge on social media, all that kind of stuff. They're doing big marketing events. They've got flashy jets. They've got flashy this, flashy that. I find that to be lowering credibility. That's probably a broad statement to make. I don't think that's true across the
Yeah.
board. But I almost feel like I have to do more due diligence on somebody who is a big name or a big expert in the industry. So, what exactly are we looking for? Define expert and how you can separate out people who are really doing the thing and consistently returning these things over time, because especially with you being younger, you really do need some of the experts who have been delivering these kinds of returns for many years. So,
Yeah.
what does that look like? When you said you spent a year doing your due diligence before you placed your first capital, most people just get excited about something. There's this charismatic person with a private jet, and then the next thing you know, they're investing and they don't know what they're doing. They don't know how to read the reports. They don't know how to read the pro formas. So, I just, that's a big topic. Go ahead and just see if you can unpack that for us, like how you identify an expert, how you avoid getting sucked into stuff that might not be true. How do you separate all that out? What did that process look like for you the first time
Yeah.
versus maybe how it's changed now?
Yeah, I think, one pretty quick way, a book specifically for multifamily, at least that I read, is The Hands-Off Investor. And that, for
Mhm.
multifamily, really dug into the weeds of
That is
questioning the underwriting model, right? Questioning the market, really, I don't even know, it's probably 100 to 250 questions, questioning the team, obviously. So actually using that as inspiration and other checklists as well that we've found to be useful over the years, we've put together a list of 100 due diligence questions you should ask any operator, regardless of the asset
mhm,
class, before they invest. And it's actually on our website. It's clivecap.com/alternative dash assets. And these, again, regardless of the asset class that you're in, these are questions that anyone should be able to answer. What's your background and why is it relevant to this investment that you're doing? Tell me about your track record. Tell me about a time deals went south and what you did. How did you handle investor communications? How are you conservative in your projections? Going through that list is very helpful. Number two is obviously testimonials, right? Other people in the industry who know this person and can speak on their character and have worked with them, right? Not just observe from afar. They're past investors, they're CPAs, insurance companies, title companies, lawyers, etc. Just see what this entire community of people has to say. Because as you and I know, investing is a team sport. So
yeah,
any person out there in the investing space is going to have a team or a sphere that knows something about them. So I think getting that information from them helps you avoid a lot of mistakes. And then beyond that, I think obviously doing your background checks, right? Investor gives us background checks, courtesy. Running those background checks are helpful. And if it's anything that's too out of left field from what you're typically doing, I put my own money first, see how it goes
mm,
for 6 months, a year, and then bring my investors on. So when I first started out on my very first LP syndication. That process was networking with a lot of people. And back then that's when Zoom had really started taking off. So I would just join 10 networking calls a week and just talk with different people. Then from there, if anyone interested me, then I would try to reach out to them and grab a one-on-one with them. And so at
yeah,
that point, I just started putting down anchors of, hey, here's who I think I can trust. Here are people who I don't know that I can trust yet. All the while educating myself. As I mentioned, reading The Hands-Off Investor, looking at practice investments, signing up for people's email lists, looking at the deals that they're sending through, getting familiar with it, taking my time on the sidelines.
yeah,
And I felt like I knew 70, 80% of it. And I put up capital that I
mhm,
could live with losing completely. I wouldn't be
yeah,
happy about losing it, but it wouldn't be the end of everything either. And so that's how I approached my very first syndication. And even with oil and gas, I'd been trying to find an oil and gas syndication for a year and a half, almost 2 years
mhm,
before I actually got into my first one in November of 2023. And I had found a couple of groups that seemed very suspicious. And I was this close to pulling the trigger on one of them. And luckily found someone else in our space to talk to. And they said, hey, steer clear of them. And
okay,
luckily, to that point, I'm a part of a lot of these different groups. Avestor, I'm a part of Race Masters, and I'm a part of Connected Capital and like fully funded. I'm able to rely on the expertise of my community and have a pretty high level of confidence that these communities are also made up of pretty high character, high caliber people who know what they're talking about. Like you mentioned, even though I'm young, I'm able to have the honor of surrounding myself with people who are older, more experienced, and can help me inform me about some of these other big decisions where I could use some advice.
yeah. It reminds me of the process of choosing single stocks versus, say, an investing fund or an ETF of some sort. The advice that most of us get is don't mess around with single stocks because you're not going to beat the market unless you're some sort of stock picking genius. Maybe 10% of people can beat the market by picking their own basket of individual stocks versus just going with an S&P fund. So the process of picking a single stock seems pretty similar to picking a single company to invest in one or multiple deals that they're doing. But can you compare that to the stock market where we're like, hey, we can't beat the index, so why bother? Versus choosing private equity, or let's just stick with private equity, whether it's real estate backed or backed by something else. Private equity, like, how are those the same and how are those different?
Feel like the businesses that we operate in private equity, like the industries that we mentioned so far, in my opinion at least, they're easier to analyze than a lot more public companies. And
Mm,
investing in them is oftentimes more lucrative. One, because they are private opportunities, and I would say two, because of the tax benefits primarily. So I think the hassle of going through the additional effort to get yourself initially educated for all the amazing returns, we typically projected target like 15 to 30% returns. It could be anywhere in that
mhm.
range. It could even fall below, but I'm just saying that's generally why we target it. And that's one of the big reasons why we like to be outside the stock market that's just done 10% a year. And then obviously the tax benefits, as I mentioned, we all know and love real estate depreciation, but even depreciation in energy is pretty powerful.
Mhm.
So that's why it's
Yeah.
worth doing the extra due diligence besides just investing in ETFs. And I get that comment from my coworkers a lot. Okay, this is too complicated. I'm just going to stick it into the S&P and 10% a year is good enough for me. And I think number two is, I don't know, I feel like the private equity opportunities, the industry changes at a much slower pace than the stock market does.
It does.
In the stock market, these companies are innovating at a very rapid pace. And also you're competing against algorithms, right? So you have to be some supercomputer that's making decisions on a scale of milli, if not nanoseconds. Whereas in private equity,
Yeah.
housing doesn't change that quickly, right? But we've seen, for example, DeepSeek completely throw the market into complete chaos in just a matter of a few
Yeah.
weeks.
Mm,
Housing, energy, anything in like intangible assets, as you said, real assets takes a lot longer to develop typically
yeah.
than things in the stock market. And then my last point is that I feel like analyzing private equity opportunities are easier than public companies because with real estate, for example, you can pretty clearly outline here's my apartment building, here are my rents, here are my expenses, here's the debt service I have to pay to the bank. Here's my cash flow.
Mhm.
Or in oil and gas, it's as simple as, hey, here's the estimated capacity of the wells, like how many barrels of oil, how many million cubic feet of natural gas. Here's the price of oil. Here's the price of gas. Here's our typical expenses. It's much easier to model out private equity opportunities than it is to analyze the cash flow of publicly traded companies, in my opinion. And even then, some are
Mhm.
easier than others, right? Like, for example, Warren Buffett invested into Apple because he understood Apple's revenue model. They're just a manufacturing company to some extent. And it's easy to say, here's how much Macs I can sell, here's how many iPhones I can sell. On the other hand, I work at Meta's revenue is a lot more difficult to analyze. Like, how could you possibly project ad revenue from a messaging app or a social media? Wall Street analysts will try to put estimates on there, but I don't even know how they come up with it.
Yeah. Yeah, we don't wanna say it's made up, but it's the difference between paper assets
Yeah.
versus real assets. I often joke that you only lose money in real estate every 10 years because of that lower volatility. Public
Mhm.
companies tend to be the same way. There's plenty of data out there showing that private equity outperforms public equity by enough to make a difference for me. I do still keep money in public markets. In fact, we sold a bunch last year and we're getting ready to put a bunch more into the public markets just because we want that diversification. But PE outperforms public as a general industry group. And I think the reason why is because it's a different index. So we're saying, oh, you can't beat the index. This is the Fortune 500, the S&P index. This is what those companies do. Here's an average of what they do. But what we're trying to do is recreate that over in the private space. They tend to outperform. And so the index is higher. So if you're diversified enough across different private companies, and there's so many more to choose from, you're actually pegging to an index that is in general higher than the public index. And for me, that makes it worth figuring this world out from a financial standpoint. But the other thing that you mentioned that makes it worth figuring out to me is as I started to associate in different masterminds, specifically for wealthy entrepreneurs or just high net worth individuals in general, however they made that money, they're all doing private markets for a huge part of their portfolio between real estate, other kinds of businesses, energy. I just saw like the really, really wealthy people out there. What got you here won't get you there type of thing. And that really changed my mindset because my biggest motivation is security. I always joke I want to be like Scrooge McDuck, swimming around in the bin of money. And I don't really want to spend it. He's a total cheapskate. I just want to know it's there. And so, in order to have so much security that I don't really have to think about what I'm spending as long as I'm just careful, to me, I wanted to be very wealthy to get rid of that money stress and that money feeling of how are we going to pay for this? That question of making my heart beat faster. For me, I just wanted to become very wealthy so that I could get rid of any of that. How are we going to pay for this kind of stress? That doesn't mean we're going to waste money or be silly with it or any of that. I just want to be able to pay for stuff without being stressed out about it. So I'm like, okay, the way we're living, that's not what's happening. You have to be very conscious and there's a lot of stress. And so just like you said, hanging out with people who are doing the thing and then you're like, oh, this is how the other half lives type of thing. So tell me about that experience as you're watching. I'm assuming you're a younger guy because you just graduated college like 6 years ago. I graduated college when I was 40. So I graduated college almost the same year. You did. So I'm making an assumption there, but getting into this business, being a little bit on the newer side, recognizing PE is where it's at, networking is where it's at. And then maybe you're not the guy to be running these deals or starting a company drilling for oil or buying multifamily. Tell me about the experience of the people around you and the confidence that gives you to just move forward and get it done. You obviously don't have analysis paralysis. What does that look like?
Yeah. Yeah, I think there's a quote, if you wanna go I forget what it is. It's about teamwork,
If
basically.
you
It's
want
like,
to
if you
go
wanna go
fast,
far
go alone. If you go far, go
exactly.
together.
Thank you,
Mhm.
Emma. Yes, that quote. And so early on, I realized that I can't do everything in a business, and I also don't want to do everything in a business. In our build to rent development, I love putting the deals together, finding new deals, putting the pitch decks together, putting the underwriting together, and raising the capital. That excites me. Asset management, I do not like. I don't want to get anywhere near it, but I know it's very important. So a lot of these companies that I'm involved in, a few, I'm not that a handful, a few that I'm involved in, I make sure there's someone who's a decade, if not preferably 2 decades more experienced than I am. And I'm basically at a few years. And Andy, who we know, has been in the real estate space for 20 years at least now. I would say I would like to think I'm second or third, somewhere in the chain of command there where I can learn a lot, but have a lot of responsibilities where I can eventually rise to that same level to the same occasion that Andy's at. And same thing in the oil business. The partner that I invested with, she was born into like an oil and gas family. That's what her family's done for
Okay.
generations. That was her childhood. And so I rely on her experience and her knowledge, learning from her, providing value where I can, and then learning, right? I would say and I verified that these people are the best to go to. I know you and I would both
Yeah.
agree that Andy's a great guy to work with. And I've heard from plenty of people that Courtney, my partner in the oil and gas opportunities, that she's an amazing person to work with as well.
Yeah, having that experience surrounding me has made a huge difference because when I started asset managing my first property, when I work for other people, like as an employee, I'm organized, right? I check all the boxes, all the edges are lined up, paper stacks. Like I'm very detail oriented, very organized. But I found that when running my own business, having to have that 10,000-foot view, I was less organized, less focused on details. I cared less. I just was really struggling with keeping everything the way that it was. And I thought I could do it because I've done it on my projects in the past. But when you're the boss and you got to focus on details, it was a bad combination for me. And I realized, okay, I don't even actually really all this asset management. I prefer the 10,000-foot view. And so putting together a business where I'm working with other people who are experts. In fact, how I found my business partner was like, I wanted to put some money in his hard money fund, and he wasn't set up to take investor capital. He was running it out of all of his own money at that time. And I said, I know how to syndicate. Like we can syndicate hard money loans, right? I want to get into this because I want more cash flow. And so it's been just like such a relief because my husband quit his job or got laid off right about the same time. And he's taken over so much of the detail ops kind of stuff with my partner who takes care of the loan ops, servicing, origination, all of that. And I, at first, didn't really want to raise capital because I don't like sales, really. But just being able to settle into this role, being a podcast host, being a writer, doing live networking events, all that stuff that goes along with raising capital means that I get to really focus on what I'm really good at and the things that I'm passionate about. And so the little bit of sales kind of stuff that goes along with that, following up, closing. I like developing relationships, but it's difficult for me to follow up and close. So that's what I mean by sales stuff. Dealing with that little bit of sales stuff has been so much easier because 80% of my time is spent doing stuff like this, talking to people like you who have a different experience. Everybody has a unique story. It's just really allowed me to blossom into my business in a way that really speaks to the way that I like to do things, which is not asset management. So I hear you there. I People are
Yeah.
like, "But you're running a business right now." I'm like, "I'm not running the business. I'm more like the public face of the business, and the behind the scenes are being handled by people who care about details a whole lot more than I do."
Yeah. It's a
Notice the same
necessary
thing with yours?
combination.
Yeah, but you're more analytical. You're a software engineer. Like you like spending time in the spreadsheet. Like you have that ability to be detail oriented. And so, how do you balance those two things in your own business? Because you got your day job, you got your business, you've got like business has taxes and finances and books and all that kind of stuff. So, how do you balance that 10,000 foot view with the details, or is it just temporary until you're able to focus on one or the other? If you don't like asset management, there are details in the business itself that still need to be managed. So talk to me about that.
Yeah, I think the goal one day is to do all of this full time. I don't know when that day will come, but making steady progress towards it. As far as managing everything I have going on, I think it comes down to a few things. And investors ask me this question all the time too. We work at the same company or in tech. How do you do all this? So I always tell
Yeah.
them, well, one, a lot of it comes down to liking what you do. So I spend a lot of my
Mm,
weekends working because the investment side of what I do is very interesting to me. So it doesn't feel the 60, 70 hour weeks don't feel all that crazy to me. And that's one. And so what you do two is building the right team around you and then delegating to them. And in our investment fund, for example, I have a few virtual assistants who handle some of the pretty simple things, emails, bookkeeping, even handling distributions for the fund they handle through Avestor. And then my business partner, John, handles a lot of the day to day operations. He hosts our podcast, Investing for Generational Wealth. He is starting to take on the role of handling our tax returns, legal
mhm.
compliance, things like that, finding new opportunities to raise capital for. And then on the built to rent business, Andy and the team focus a lot more on the asset management piece of it and managing our partners, our contractors, handling tax returns, syndication documents, all of that. I mainly focus on, again, finding new deals, talking to property management companies, getting my pro formas in place, putting pitch checks together. So, like, teamwork, as we said, is another way I'm
Mhm.
able to balance it. And then the third reason is I'm a little crazy. Yeah. Yeah. I like what
Yeah,
I do,
I
able to
said
do it
no.
all.
If you like what you do, it doesn't feel as much like work. Like I said, if 80% of it is something that you really would do anyway, whether you're getting paid or not, then you can put up with the other 20%. So if you're working extra hours, you're only working 20% more hours when you think about it that way, because 80% of it is really interesting. So that's a good point. Liking most of what you do has been a big key for me. Okay, so I said at the beginning, we're going to dive into this tax thing. So my husband and I are both real estate professionals, but even when I was the only real estate professional in the family and he still had a W-2 tech job, I was able to offset his W-2 income with depreciation because we owned properties that had depreciation. When we switched over to private lending, that's considered active income. But again, I didn't worry about it because as a real estate professional, whatever, we're not paying income taxes on our active income. So it offset the W-2, it offset my private lending profits. And then I kept enough depreciation around for tax benefits. And then also the depreciating in real estate are appreciating. So I'm getting my growth and my depreciation through the same asset. So that's really been the cornerstone of our tax strategy is things that are growing in real life while they're depreciating on paper for taxes and real estate professional status so we can not have to worry about paying income taxes on our active income. And my husband's a real estate professional himself now. And so for us, it's we could go get jobs or one of us could go get a job and still not have to pay taxes. But like you said, a lot of people in the W-2 position where especially when they're both W-2, both spouses are really getting shafted on taxes because you can't be a real estate professional unless one of you is working full time. Or what about a single person who has a day job and is burning the midnight oil on real estate? You can't do both. You can't have both. And so
Right.
talk to me about the tax benefits of energy versus real estate and how that works on offsetting active income.
Yeah, sure thing. As you mentioned at the beginning of the podcast, we're not any sort of tax, legal, or financial advisors
Yeah.
or professionals. Definitely talk to your.
This is what we're
This
doing.
is
Doesn't mean what you should be doing.
yeah. This is honestly purely for entertainment purposes. That's it. And on a more serious note, as you real estate's obviously better than the stock market with tax benefits. The stock market's bare minimum. It's sad in my opinion. Real estate's the next level where at least your investment income goes tax deferred or not taxed at
Mhm.
all, depending on how you invest. But you're right. As you mentioned, you cannot take it against your W 2, even if you have two jobs. I'm in this boat. My CPA has also told me don't try to do it. That's just a red flag for the IRS. You're putting a bullseye on your back.
Audited. Yep.
Yeah. And then people try to do Airbnb rentals because it does give you some benefit, but that's basically picking up a
Mhm.
second job, which none of us
Oh,
are in this
yeah.
business to do. Unless you like it, then all power to you. So we're
Yeah,
looking for
I
a
don't.
passive investment that brings you tax benefits that you can use to reduce your W-2 income. So we want a vehicle that's passive, but still lets you reduce your W-2 income without either of you having to change industries or anything like that. So I heard about 2 years ago at this point that oil and gas can do that for you. And so again, another thing that sounded too good to be true to me. So I spent time finding people, eventually put my money with one of the partners that we work with now that I mentioned, Courtney. And at a high level, for folks like as to why you should care, I'm a software engineer at Meta. Every 100K invested into this oil and gas deal that I invested in November 2023, I got to reduce my W-2 income by 80K, taxable W-2 income.
Wow.
Yes. So depending on your tax situation, that comes out about 30 to 40K in actual tax savings, right? Assuming you're
Mhm.
at a pretty high marginal tax bracket. So year one, you're already getting a 30 to 40% return. Obviously, you want to make sure that you're still going to get returns beyond that. And it's not just the tax savings, because otherwise you just lost 60 to 70K.
Yeah.
And that's how a lot of these oil and gas guys will try to get you, is with the tax bill.
Mm,
But
so it
go ahead. Go ahead.
yeah, so the but part is like they're talking about the tax benefits, but the underlying deal is no good, then the tax benefits don't matter. We talk about this a lot in real estate with the opportunity zones. We had an
Mhm.
opportunity zone project at one point, and a lot of people were looking at it because they needed the tax benefits, and it was really important to us in the pitch deck and in our projections that we were like, "This is a solid deal here." There were no tax benefits to it being in an opportunity zone. It has to still meet our same threshold that we would already have for, am I going to do this deal or not? What makes it extra juicy is that it's in an opportunity zone. And so it sounds to me like what you said is like some of the oil and gas will try and get you in by talking about all the tax benefits, but maybe then people are investing in stuff that's not sound at a fundamental level. And so watching out for that and finding experts is really key there.
Business model, at least, is we have what are called landmen in the oil and gas sector. That's what realtors are in real estate. Landmen
Mm.
track transactions of mineral land. So we establish contact with them. We have connections with them. Once they notice that a big company like Exxon, Chevron, for example, some billion-dollar oil and gas companies buying up land in an area, that means they know that this company knows that there's oil and gas in the area. Now, my understanding of how mineral rights work, as long as you buy land in that area, in that vicinity, it doesn't have to be exactly where the drill goes into the ground, but in the vicinity, you are entitled to a portion of the revenue from that oil and gas
Mhm.
being drilled.
Okay.
So that's how the revenue is made because you're the landowner. Now, the tax benefits come because you acquire it using I believe it's a working interest. And what that basically means, the risk there is that in case the company ever needs more money to complete drilling operations, you have to come out of pocket for it. But my partner, who's been doing this for decades, she's only come out of pocket a couple $1,000s across hundreds, maybe even millions of dollars that she's probably invested.
Mhm.
So the risk is minimal. But in order for that small risk, you get this massive tax write-off. Again, every 100K invested, reduce your W-2 taxable income or even capital gains by 80K. And that depreciation is from a lot of the same thing, right? The equipment that is bought that can be depreciated. There are other tax benefits like a depletion allowance, which is basically the government giving us a write-off, recognizing that eventually y'all aren't going to get any revenue because the oil and gas is going to be depleted. So they give you depletion allowance as well.
Okay. Yeah. This is not really something that I have gotten into personally for a couple of reasons. One, I'm a lot older. And so the shale revolution, vertical drilling, fracking, none of that was a thing. And so I grew up on stories of drilling an empty, like
Yeah.
my parents' friends or whatever. And so I don't know much about the shale revolution or the new ways that energy is extracted. But one thing I've heard just a few years back, it's been a while, that energy consumption tracks a 1 to 1 with GDP. And so to me, that puts it in the same category as shelter. Everybody needs a place to live. And so that's why I like residential real estate. But at the same time, we also do commercial and a few other things like that because not everybody needs a place to work, but most people need a place to work. But then energy consumption tracks with GDP. It's kind of everybody needs energy, which we all know that. We all are plugging in our iPhones, whether we're just doing it as a consumer, we're running a power plant for crypto mining, right? So to me, it's like that's a huge determining factor of economic success and shows me that we really need to be in energy in general. But the thing that's been holding me back is because we have great tax benefits as real estate professionals, but also because we're really focused on cash flow because we're already left our jobs, we're already living full time on our investments, and it's got a cash flow. And maybe one of the things that we're looking forward to doing is through our business or through other ways to earn money is to grow so we can be more focused on the diversification between cash flow and growth because right now we're so heavily into cash flow that we let our diversification on the growth side suffer a little bit because we need to take care of today. So the cash flow to me has been the biggest reason why we haven't spent more time getting into this. And so can you talk to me about the different kinds of deals that you can do in energy? Which cash flow and which will possibly hit an empty hole? How does that all that work?
Yeah, I will clarify, I'm still learning as well. My
Mhm.
understanding so far, as you mentioned, the shale revolution was big, horizontal fracking was big, so that even if you hit an empty hole, you could just go sideways and you will likely hit something, or higher
Mhm.
chances at least.
Yeah, hard.
There's still a chance though that even if there's mineral deposits in the ground, that it might be commercially unviable to reach them.
Yeah.
If there's, I don't know, really dense rock or something, you can't drill through it, that is still a risk, and I don't wanna downplay that. Obviously, the price of oil, and that's a very volatile market too, for various reasons.
Mhm. Oh, yeah,
That's
we lived
another
in
risk.
Texas for 20 years. So many of our friends were like, boom, bust oil cycle. They'd
Mhm.
be out in Midland drilling, or they'd be back home because looking for another job. And they had like side jobs that they would do in between oil booms because they had have another career. So some of them would
Yeah.
do real estate agent, insurance sales, like all sorts of crazy stuff. So living in Texas for so long, I think has made me more leery of the volatility of oil and gas and why maybe that's a third reason why I've stayed away from it a little bit. Anyway.
So I would say a couple of things. The risk definitely exists, but when we buy land, we buy multiple wells. So it's not just one drilling spot, there's multiple.
Mhm.
I helped investors invest into an opportunity in December. Right, like end of year, you need to get your investments in for Uncle Sam if you want to reduce taxes. And I help my investors, primarily from Meta and Google, invest into 8 different wells. So all 8 would have to go bust for you to be significantly at risk. Usually how it works is some wells, anything in life, some wells are underperforming and really sad. Other wells are average, right? And then you have your rock star wells that just hit it out of the park and compensate for everyone else. So that's another way we diversify and reduce risk. And then to your point about cash flow, my oil and gas deal has been my best cash flowing investment so far, even more than the private debt that we're into. So I invested in November of 2023, got the tax write off. That's great. An additional 30, 40K saved. And we can even call it earned. But I'm not going to count it for
Mhm.
purposes of the discussion. 6 months after, I got a check for, I think it was every 100K invested, 4K. So every
Okay.
month I made a 4% return for the first 6 months.
Okay.
And it starts petering off. Right now, I think I'm making 1.5% return per month on my
Okay.
oil and gas. And
Okay.
obviously it
Yeah.
decreases over time. But the
Yeah,
goal
but
is, I was going to say, between the real quick, between the tax savings and the cash flow, you'll have 100% of your capital back typically within 2.5 years. You'll still
okay.
continue cash flowing after that, but now you have your principal back. You can redeploy it into another deal. And it's basically
Mhm.
infinite cash flow, if you want to call it that.
Okay. Yeah, because our fund pays out 12% for anybody who's invested more than 200,000. 12% is 1% a month. So that sounds
Yeah.
pretty cash flowy to me, honestly. Maybe we should get into this because I feel like we preach diversification big time. And so I try to eat like my own dog food, so to speak. I want to be diversified not only to the different kinds of things that our fund invests in, but also outside my fund with other fund managers, again, in paper assets, some of it's real estate rentals that we own by ourselves with no partners. Like we have a variety of things that we invest in. And energy is just not been one of them. Another thing I've noticed is I'm not an early tech adopter in general, and maybe talking to a tech guy that's not maybe as understandable. I wait. It's just like with pharmaceuticals. I don't want the newest, best, greatest drug. I want which one has been around for 20 years, has stood the test of time, no weirdo side effects. That's how I am with technology. I just want to see what's really going to take. And so I'm missing out on early stage stuff, and I'm fine with that. I think that VC
Yeah.
funds show that they return less than the market. So I really avoided that as an asset class, venture capital. But again, just diversifying across multiple asset classes, different risks, different types of assets. To me, that's important. And my investors and people who listen to the show need to really learn that lesson. And I want to I want to actually do what we preach. And so this is something, this is not the first time I've heard that oil and gas cash flow is better than even some of their real estate investments.
Yeah.
Uh, you usually hear it 2 through 4 times and you start to think, "Okay, I gotta look into this." So, how do people get a hold of you if they want to start looking at ways to diversify? And let me just add here, if I went into an oil and gas directly, right, I would be getting a separate K-1 from that company. Whereas what you
Mhm.
are doing is you got real estate investments in there, you got energy investments in your investor fund, you have all sorts of things. I could go in and buy into one of your real estate projects or buy into your oil and gas and not buy into anything else. Like I and still get a single K-1 from every investment I did in your fund, which is fairly diversified. So how do people get a hold of you if they want to get into some of these benefits and take a look at the deals that you're offering?
Yeah, I would say one clarification, unfortunately, as I understand right now, at least with the fund of funds model and what I've talked with Sanjay about, we cannot bring oil and gas or other energy investments
Oh,
into
that
fund of funds.
I did
Basically,
not know that.
yeah, it's sad, but basically the reason you can't is to be able to write it off against your W-2 or other types of income. In the first year of these investments, you're classified as an active partner on your tax. That's what it shows. It doesn't show limited partner, it shows general partner. That's what it showed on my 2023 tax return. But in a fund of funds, we can't do that because we assume all of our investors are passive. So that's my understanding, but it's one additional login. But besides that, real estate, private lending, I believe small businesses too, these can and will and are going all into our investor one-stop shop portal. So
Yeah, that's really interesting because I feel like I heard the first time we started looking into oil and gas a few years ago, we still haven't done anything with it.
yeah.
But she was talking about how we could 1031 exchange out of oil and gas just the same way you do real estate. I don't remember if it's because they own the land that they're drilling, like they buy the actual land with the mineral rights, or if that's just it's like for do you know anything about that? About 1031 exchanging out of an investment like that into something else, like when you get your original capital back, or how does that work?
In oil and gas, I'm not as familiar. I think I do remember seeing something that you could transition from just owning mineral land, but not having a working
Mhm.
interest, and then into a working interest and back and
Okay.
forth. But again, something more nuanced I'd have to study up on. And in the syndication, it's more difficult because you typically, at least, would have to have all members of the syndication agree to 1031 from one to the next.
Right.
And
Okay.
I would say, lastly, this model that we're investing into oil and gas with, we never sell the land because these wells, they're producing 30, 40 years from now, too. It might be a couple $100, but at that point, you have your capital back and way more. Why sell the land, get hit with the tax bill? I believe you have to recapture your depreciation even in oil and gas, too. So why
Mhm.
go through all of that
Yeah.
when you could just move your money and cycle it into the next thing? But
Yeah.
these are still
Yeah.
things that
Yeah.
I'm learning about every day too. To your
It
original question about reaching out.
it just it speaks to your commitment to diversification as you are learning and testing things out on your own money and meeting people before you bring in investors into a project because that's how we all learn, that's how we all do it. And so you have things tried and true that you're offering and then things like you said even maybe private business loans that don't have a real estate component, just continuing to build that over the coming years as you delve into each individual one. So it's a good opportunity to diversify with a little less headache of tracking. So I appreciate you sharing that with kind of walking us through your process about how you find a new thing to invest in. You don't have to be the expert if you're passive, but you do have to be an expert at finding experts.
Exactly.
So, what's the name of your podcast? Where can people find it? And where can people find out more about your investing opportunities?
The best way to reach me is with my LinkedIn. If you just look up my name here, Keshav Kaur, or my email, just Keshav, my first name at clivecap.com. Someone else has taken class capital. So that's the best we could do for now. And it's actually a London-based hedge fund that went bankrupt trying to trade oil. Yeah. I don't know how I feel about that, but
So,
it
no,
was a
no,
name
no,
we really like.
yeah.
Yeah.
Uh,
The website's a good way to reach out. Definitely check out clivecap.com/alternative dash assets. Not only is that due diligence checklist there of 100 questions you can ask, no matter what investment you're making, what asset class, but also there's a two-pager and an ebook about why you should invest outside the stock market, what the ultra wealthy do. And hint, most of their money is in commercial real estate, not equities. And it goes through why you might not have heard about these opportunities before. A lot of the basic questions about investing outside the stock market. And lastly, our podcast is called Investing for Generational Wealth. We release an episode every week. And Emma, we'd love to have you on there as well if you haven't signed up already. Those of you listening at home, give us a listen and review there as well.
Awesome. Yeah, I feel like the best place to talk about your podcast is on someone else's podcast because you're talking to an audience of podcast listeners.
Yeah. I don't know why I didn't think about it before, but I think this is the first time I'm mentioning our podcast on another one. I should probably do that more often.
Yeah, I definitely have started doing that when I'm interviewing on other people's podcasts because promoting on social and things like that just, I don't know, feels like kind of a waste of time. And so to me, it's if you want it to get at podcast listeners, then you should talk to podcast listeners,
Yeah.
which is the kind of person that I like to work with because they enjoy long form content and we become like this real person, even though it can be at first like a parasocial relationship where they're just hearing our voices in their ears for hours at a time sometimes, but they're more likely to reach out and actually do business together than somebody who sees something somewhere else. So I think it's definitely one of the markers of the investors I prefer to work with who really want to get educated, but still want to be passive. That's my ideal. Who's your ideal investor? Can you tell us a little bit more about that?
Yeah, I would say it's anyone who's honestly been a similar boat to me. I mentioned I used to work at Amazon, now Meta. So anyone else who's a tech professional working at one of these large tech companies, in addition to the two I mentioned, Google, Nvidia, etc. I feel like I was in a similar boat to you, only in the stock market. So would love to help you at least begin exploring this market of alternative investments, diversify outside of public equities. We all saw what the market did with the news of DeepSeek and hundreds of billions, I
Where
think maybe even up to $1 trillion was wiped out in a single day. And that's one, it's a lot harder to do in real estate. And if it does, you better believe the stock market's crashing just as hard, if not harder. And no strings attached. Would just love to educate you and you take your time asking your questions and we're here to help you answer and hopefully get you into alternatives.
Yeah. That's one thing I've noticed about tech workers in general. My husband's in IT in the data science world. And so working with a lot of his colleagues from data science or other IT professionals, the due diligence process is very important and it takes a while. And so there has to be no pressure from our part as fund managers to say, "Well, if you sign up
Yeah.
today, none of that stuff." And I think that what it fosters is more of a slower building of trust, which is the foundational better way to do it anyway. And so I do actually really like working with some of our engineering tech minded people who are going to go through proper due diligence. By the time they invest, we know that they've put us through the ringer and we can
Yeah.
just get on with the business of making money together.
Yeah.
All right. So thank you for sharing your story with us. It's definitely a little bit different than anything we've heard on the show before, which I always love having a guest who has a little bit different perspective and a little bit different pathway to building success. So thank you for coming on today and looking forward to talking to you more because I also need to get educated about diversification myself. So I'm sure I'll be reaching out and hopefully be on your podcast sometime soon.
Please. Yeah. Appreciate you having me on today, Emma. And thank you to those listening at home too.
All right. Thank you, Keisha. And if you're listening, be sure to reach out to me at partnerwithrise.com if you want to jump on our schedule, talk to me or one of my partners. Would love to, like Keisha said, no strings attached, just education, just helping you through this process so that you can figure out how to turn your income from your job or your business into generational wealth, which is why we're all here to spend more time with our loved ones and bless our families' lives beyond. It's not about just retiring early or working less. It's about really making a difference in the lives of the people that we're close to. Would love to have that conversation with you and help you figure out what you want to do or where you want to go on your next passive income adventure. Until next time.